My name is Rita. I'll be taking you through financial accounting for level one. I want to believe we're all on level one and we're in the right class today. Thank you for making it to this lecture. Today we're going to be looking at bank reconciliation. I know some of us must have heard or we have an idea about it. So we're going to get started in a short while. Let me share my screen. Let me know when you can see my screen and then we can get started. Can you hear me? So in case you have something to say, the most of the times we're going to be using the chat. I hope you're aware of that. We'll be using the chat to communicate. In case you have any questions, you also use the chat. But for now, since I'm meeting you for the first time, I've told you my name, I'm Rita. I'll be taking you through financial accounting. Let me hear your names and we can get started as I try to get the screen. Yes, is there anyone who wants to introduce them or tell us a bit about themselves? Okay, I will take it that none of us wants to talk about ourselves, which is okay. Um, with my class, I would like for us to be a bit participative. I'd like for us to be active in class. I believe it's the best way to learn. It gives you opportunity to pay attention and also be able to notice where you may be in error or where you might have not easily understood compared to the person who's going to sit in this class and just look at the screen. Also, I hope we have our books and we are ready to go. Sorry, it's taking me a while to get these notes. Just give me a quick second. I apologize once again. Thank you for the introductions. I thought it would be a bit more vocal, but it's fine. This will also do for today. Let me share my screen. I got the notes. I'm so sorry again for that. And we can get started. I hope you can hear me clearly. Okay. So as the document is opening up, we have heard of cash books. I know we have met cash books. We have studied a bit of cash books. We know that we use cash books to record transactions that we make as a business on cash basis. I know that you are aware of that concept, all right? So what happens with bank reconciliation? I think that I'm going to have to let you know before we get started. I am a person who believes that things do not have to be hard. Most students approach CPA with an attitude that things are extremely hard, and I don't believe that's how it's supposed to be. I believe it's about the attitude. It's about putting in the work, studying as much as you can. Please discuss with your friends, make friends as you are in this sitting, make friends with your colleagues, discuss as much as you can, challenge yourselves, and it's going to be fine. Please, 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 let's attend classes. Let's try to not miss the lectures. And let's ask where we feel we do not understand. Attempt as many questions as you can. Familiarize yourselves with the question banks so that when it's time for the examinations, you're not going to be shocked. Because the truth is, if you've not read and practiced enough, you'll find new things in the examinations. So practice and also have an attitude that you can do it, because I believe we can all do it. So for us, as we are in this class, I don't want anyone who is going to say CPA is hard. CPA is not hard. You just have to put in the work. And as we know, nothing in life comes easy. So like I was telling you, you've had experience with cash books. You know that when a business is making transactions, it will probably make them through the bank, or it will make them through cash. You have experienced bank reconciliations. You've experienced bank payments as well as cash payments. You've experienced cash books. You've experienced. I know you've studied single column cash books. You've studied double column cash books, and you know how to treat what. So is there anyone else? Is there anyone who might not know the concept of the cash book by now? In case you do not, please feel free to reach out, and we can just basically find you feel free to reach out to me or your colleagues or Innocent, and we can take you through it. So just like a cash book, you saw that you had closing balances with a cash book. Um, just like with a cash book, the bank statement also has transactions that happen to it that need to be recorded in a particular way. And ideally, an accountant of a company, ideally, what happens is that an accountant of a company, just like you saw in the columns of the cash book, we have a bank column, we have a cash column. In the bank column, the bank balance that is in the bank column. Okay, so if you had, let's say, if you had a cash book and you have maybe cash balance of 10,000, and in the bank column you're showing that you have a balance carried forward, stroke a balance brought forward of maybe 20,000. That 20,000 needs to be exactly what is in the bank statement, because what your cash book is trying to say when you show that you have a closing balance of 20,000, you're trying to show that in the bank you have 20,000 left. So ideally, when someone picks a bank statement, that should be the same exact balance that is there. So what happens when those two balances differ? Maybe the cash book balance has 20,000 and maybe the bank statement has 25,000. You as an accountant of the business need to sit down and make sure that those balances agree. So basically, that's what the concept of bank reconciliations is about. We are trying to make sure that the cash book balance and the bank statement agree. And of course, there are very many reasons that could influence the differences between a cash book balance and a bank statement balance. And those are the things we're going to look at. How do those differences arise, and why do they arise, and how are we going to deal with them? So basically, in the overview, that's basically what bank reconciliation is about. So let's deep dive into it. We're going to look at the introduction to the reconciliation, the types of reconciliation that may be there. We have and the bank reconciliation itself, as well as the bank statement and the bank reconciliation processes and the format of the adjusted cash book, as well as the format of the bank reconciliation statement. So before we go forward, we have to always know, or we have to, this is just basic knowledge. Usually, or 99% of the time, the bank statement is usually going to be correct. It's the error rate of the bank is like 0.5, and because of that, we usually fine tune our statements according to what the bank tells us to do. But that doesn't mean that the bank does not make errors, as we'll see in the questions that we approach later on. The bank does make errors, and so you have to be keen. Just because the bank, we have a day-to-day statement that says that the bank doesn't make errors, doesn't mean that the bank is not going to actually make those errors. So you as an accountant, you as a person who pays attention to detail, it's your job to make sure that you spot out those errors and you reconcile those differences. So what is reconciliation? We're saying that reconciliation is the process of bringing into agreement positions between two or more parties. Like I've said in the example, we have our cash book balance being 20,000, and we also have our bank statement being 25. The process of us trying to make sure that both of them speak the same language, or both of them have the same statement, is what we are going to call reconciliation. Before we even go to finance, you may have your boyfriend or you may have your girlfriend, whichever it may be, and you will find that maybe you disagree on let's say whether you want to sleep with the lights on or not. So you find that one person wants to sleep with the lights on, another person wants to sleep with the lights off. And you sleep in the same house. Okay, maybe you actually sleep in the same house. So you're not boyfriend and girlfriend, but maybe wife and husband, whichever is going to suit you in this particular example. So you find that you are at two different points, and both of you think you're correct at your different points. But at the end of the day, you need to make it work. You're not going to leave someone, you're not going to walk out of a marriage or a relationship because the lights, one person wanted the light off and the other person wanted it on. So what you will do, you will find a point of agreement. Maybe you will decide according to maybe what kind of couple you are, that maybe you will decide that you will sleep in different rooms for each one's comfort. That's a point of reconciliation. You could decide that you have low dim lights, so it's a 50-50 agreement. That is a reconciliation. You're bringing arguments, you're agreeing two different positions of two different parties, and that's what a reconciliation is about. I might have used this example and you may think it's a bit far off, but when you're attempting numbers about bank reconciliation, even in practice, you have to always remember, the moment you see numbers not agreeing, then it's your job to make them agree. And what does that mean? You have to look for why they are not agreeing and make them agree. Find the reason and solve it. That's what bank reconciliation is about. We will see dishonor checks, we will see direct debits, we will see bank charges not included. All those will be reasons for disagreements, and we will find where to place those particular items to make both the statements agree. And so usually because we adjust the cash book according to the bank statement, we usually end up with an adjusted cash book. And these are formats we'll also be looking at in a little while. So what are the types of reconciliation in accounting? We have a bank reconciliation, we have bank reconciliation is basically having the bank statement and the cash book agree. Bank statement and cash book balances agreeing. Accounts receivable reconciliation is also basically having the customers and the trade and business agreeing. So if you say you're demanding John 10,000, John needs to also be able to say that he's being demanded 10,000, not you knowing that you're demanding John 10,000 and him knowing that he's being demanded 9,000. That is if John is your customer. Same thing with accounts payable reconciliation. What you think you're being demanded should be actually what you're being demanded. So if, let's say, you have a supply of water, maybe you have Rwenzori supplying your office water, and Rwenzori knows that, and you know that maybe you're supposed to pay Rwenzori 10 million per 6 months, but maybe Rwenzori knows that maybe when Rwenzori sends the invoice, it shows that it's demanding 15 million. You need to be able to reconcile and find what that difference could be. So that's basically what reconciliation is about. And of course, you create an account to help you make those adjustments. So for this particular unit, we're going to be focusing solely on bank reconciliations. We're saying that a bank reconciliation is a comparison of a bank statement, usually depending on how big the business is. For some businesses, it will be sent on a monthly basis. For some business, that's usually for businesses that have very low transactions, 1,000 transactions, 2,000. That would be like on a monthly basis. On a weekly basis, depending on how much traffic or how many payments the business makes, or even on a daily basis. So you find that there are businesses that purely pay cash and they have to keep on sending money out every single day. And then you find that there are businesses that will decide to settle, they will decide to settle expenses like maybe once or twice or 3 times a month. Honestly, if you're making payments once a week, why do you need a weekly bank statement? Why can't you just wait for a month? Because you also know that at the end of the day, this bank statement is being charged, you're charged for it. And as an accountant, you need to be able to minimize costs. So we're saying that differences between the balance in the bank statement and the balance in the cash book will be errors or timing differences, and they should be identified and satisfactorily explained. So these are basically the reasons that usually will cause any differences, that will usually be the reasons for the points for reconciliation. We're saying that there could be errors on the side of the bank, or errors on the side of the cash book, or just basically timing differences. When you talk about timing differences, we mean that the cash book may record a particular statement at a different time from when the bank records it. For example, we're going to look at checks. Sometimes when the cashier of a business will write out a check, immediately they will have to record that transaction as and when it has occurred. That's an accrual basis, regardless of whether the money has been picked out of the bank or not. So you may write a check to someone you may write a check as a payment to maybe one of your suppliers, but the supplier decides to take it to the bank a week after. But you recorded that payment 1 week before. So you find that the bank is going to deduct that money 1 week later. So you find that there is a difference. If let's say you wrote the check on Friday, and this person had decided to take it to the bank and cash it on the Friday after, if you were to check your cash book as at the first Friday or the Friday on which you wrote that check, you find that the cash book balance and the bank balance will be different. Why? Maybe you wrote a check out of 10 million, and so for you you've already gone to your cash book and you've credited that 10 million. But you find that the bank has not done anything, has not removed that money from your account. So that money will still be there. So you find that the difference is the balance has a difference. So we have the bank statement and the cash book. Like I told you, we need to understand before we can easily go through the bank reconciliation statement, or to make it very easy for you to go through the bank reconciliation statement, you need to be able to understand the cash book, because basically the cash book is the other side of a bank statement. It's just the mirror version of the bank statement. Of course, some items will change, but basically the bank column of the cash book is the mirror version of the bank statement. Where you credit in the cash book, the bank will debit. Where you debit in the cash book, the bank will credit, as we know. And that is something that confuses very many students, because you're used to your normal double entry, you're used to your normal debit credit. You're going to think that the bank also reacts like that. You need to be very, very keen about your debits and your credits. That's one of the things that make this topic a bit challenging for people. But once you know that it's just the mirror, that bank statement is a mirror of the cash book and vice versa, then it also makes it one step easier than it would have been. So we're saying that in theory, the entries appearing on a business bank account should be exactly the same as those in the business cash book. That is to say, ideally, just like how you saw your cash book, whenever you are paying out money, you are crediting. Whenever you are receiving money, you are debiting. Ideally, that's how the bank statement should be. But then again, that is in practice, or in reality, that is not how it actually is. The balance shown by the bank statement should ideally be the same as the balance as the cash book balance. We're saying that the cash book of a business is the record of how much cash the business believes that it has in the bank. Believes. So this goes to show that there is some form of subjectivity. we're saying that in the same way, you might keep a private record of how much you think you have in your own bank, perhaps by making a note in your checkbook of income received and checks you write. If you do keep such a record, you'll probably argue that your bank statement is really exactly the same as your own. We may not be able to actually even write checkbooks, but for those of you who earn maybe salary on your bank account, you'll find that at times you're expecting a particular amount of money, and when you go to and you're expecting to have a particular balance, and when you actually open your bank app or your bank statement, you find that you have a different balance. So usually you even take it the next step and you check what happened, where was your money deducted. And so you find out that maybe the bank took maybe 500 shillings for SMS, another 500 shillings because maybe you sent money to someone, or maybe you have a direct debit that was not honored. So you find that you who was expecting to have 5 million on your account, you have 3 million. You was expecting to have 5,000 on your account, you have 1,000, and you didn't know what exactly happened. So we're talking about the discrepancies between the bank statement and the cash book. Why would these differences happen? We're saying, why might your own estimate of your bank balance be different from the amount shown on your bank statement? What could be the reason why you go to your account knowing that you have 5,000 and you find out you only have 1,000? What could cause that? That's what we are now trying to find, the possible reasons for this particular difference. We are saying that one of the reasons will be errors. One of the most common reasons will be errors. That could be errors in calculation. That is to say, maybe you thought you have 5,000 because you had calculated maybe one person sent you 1,000, another person sent you 2,000, another person sent you another 2,000. But yet maybe one of the people who promised to send you the money didn't actually send it. So we have that, the errors in calculation. And then the errors would also come about as recording incomes and payments, whereby we have errors that could come about as recording income and payment, and we're saying that most likely to have been made by you, but than by the bank. So this is the case of the check example I was telling you about. You write out a check and you record it, and you think you've actually paid out that money, but yet the bank hasn't actually paid it. Sometimes it will be just an issue of gross settlement. It will be an issue of you've paid the money you've sent out money today, but because maybe you're sending money to another person in another country, it will take a while to reflect that that money has actually been deducted on your account. So you find that it's something like that, and it can always be rectified. We have bank charges or bank interest. We're saying that the bank might deduct charges for interest on an overdraft or for its services, which are not informed until you receive the bank statement. This is usually for those accounts that are OD'd. We call them ODs, overdrafts. Those accounts that, when we talk about an overdraft, you talk about accounts that are able to get money that they actually don't have. So you find that the bank can allow you to withdraw much, much more than you actually have. So let's say you have 200,000 on your account, but you find out that you can withdraw 500,000. Where has that extra 300 come from? You? That is what we call an overdraft. And usually those overdrafts are basically forms of loans. It's just a credit facility, and usually to attract interest. So you will know that yes, you borrowed 500 and you come and debit your bank and you say that you got that money, you debit your cash. But at the end of the day, when the bank is deducting off this overdraft, it's going to deduct maybe 550 because there was a percentage of interest that you are not aware about. So until you check your bank statement, you may not know that that interest was charged. And then we also have timing differences. There could be another reason as to why we may have discrepancies between the bank and the cash book. We're saying that there might be some checks that you have received and to your account. Some cash has been added to your account. It has not yet been acknowledged by the bank, although it will soon once the check is clear. This I've already explained. Similarly, you might have made some payments by check and reduce the balance in your account in the record that you keep. I've also explained this. So I explained this from the point of view paying out the check, but it could also be from a point of view actually receiving a check. So maybe one of your receivables, one of your debtors pays you, they may decide to pay you by check, but they tell you that this check is going to mature 3 days from the time they have written it. As an accountant, I hope you know that you don't have to wait for the day that check matures. You have to record that transaction on the day that you actually got the check, because that's when the transaction happened. Accrual basis, accrual basis, accrual basis, accrual basis. Always remember that transactions are recorded as and when they occur, not as and when cash is exchanged. So you will record that maybe the check was written on 22nd of May. You will indeed record that you received income on 22nd of May, even when you have actually not yet seen the physical cash. So you find that you're showing that you have more money, but the bank is saying, no, we've not seen this money and we don't know about it. So you find that there is going to be that kind of difference. So the bank statement, we are saying that it's a common practice for a business to issue a monthly statement to each credit customer. Usually businesses issue this sort of statements. It may not even be necessarily a bank. Even normal businesses, if let's say they are big businesses and they have very many different customers who buy from them very many things, they may decide to have a statement of account showing these different items. But for the sake of this topic, we're going to look at the bank being the business that is issuing the monthly statement. So the bank also, just like any other business, issues monthly statements to its customers. So it will be the balance owed at the beginning of the month, any new debts that could have been incurred during the month, any payments during the month, and any balance owed at the end of the month. So the same way, like any other business may send that statement of account, the bank will also send that statement. So these notes have already gone through them, basically talking about the bank being a mirror image of the cash book, the bank statement being a mirror image of the cash book. When I talk about a mirror image, we know, all of us, we know that when you're in the mirror, okay, and you have written a 7, in the mirror, this 7 will not reflect like that. It will reflect like this. So it shows you it's the same 7, just different sides. So what that means is that when you debit, okay, when you debit in your cash book, the mirror version of the debit will be a credit in the bank. So you have to always remember that. When you credit in your cash book, the bank will debit. Even you see this with the messages that you receive or with the transactions that you get in the bank. When you get money, it's called a credit alert. It's called a credit alert. When the bank is deducting money or when you're paying an expense, it's called a debit alert. Please do not let this confuse you with the normal debit statement, with the normal debit and credit that we know, the normal double entry. Also, to help you understand this better, because I know most people get confused with this whole debit credit business. To make this, to help you understand this better, when you, as a person, you walk to the bank and give the bank your money, okay? You have literally told the bank to help you keep money. So that bank has an obligation to you. Okay, it has an obligation to keep that money safe and do with it what you wanted it to do. So if you told the bank, I'm giving you my 8 million, but I want you to be giving me interest of, maybe you've taken a fixed deposit of 8 million, and you're telling the bank, I want you to be giving me interest of 10%. The bank will get 10% of that 8 million and be giving it to you every month because you told the bank to do that. What does that mean? Is that the bank has an obligation to you. Why I'm using the word obligation, I want you to relate it to a liability. The bank owes you a service. So when you tell it to keep your money, it is up to the bank. It's its duty and its responsibility to keep that money safe. So why we're going to call it a credit is that money doesn't belong to the bank. So let's take it that you are the bank itself. When someone makes you keep money, when your liabilities are increasing, you will credit. And so you find that when you give money to the bank, okay, when you give money to the bank, you're holding it accountable. So to the bank, you are actually a liability because it has to pay you back at some point. It has to give you your 8 million back. And so because of that, it's going to credit. Okay, it's going to credit your account when you're giving it money. And once it gives you that money, it will debit the account because why? The liability is now reducing. So that is it from the bank standpoint. So if you can't understand it from if you can't understand the cash book versus bank from the mirror image concept, you can always put yourself as the bank and imagine you are the bank, and you see how you would record the double entry. I don't believe in cramming. Accounting is basically double entry. Once you know your double entry, you're good to go. You can cram as much as you can, but you always find a question that will need you that will examine on your intellect on how you actually understand the concepts. So familiarize yourselves with double entry. Know what is on the debit, know what is on the credit, know your assets, know your liabilities, know your incomes, and see what kind of movements they make when they increase or decrease. Okay, today I will not be able to illustrate it for you. Read up about double entry first, go back to your notes first, remind me in the next lecture that I can illustrate for you very well how the movement of double entry is. Why I emphasize double entry is that we are going to look at so many topics. We're going to look at contra accounts, we'll look at non-current assets, we'll look at financial statements themselves, we'll look at TBs, everything we're going to look at, every single concept we're going to look at in accounting will have double entry. You just cannot do accounting if you've not mastered double entry. And double entry is something that you can master. So practice, practice, practice. If it even helps you, go back to the basics. Find the easiest questions that you think are there. But as long as they're on double entry, test yourself until you can sleep, wake up, and know what kind of entry a particular transaction will be. Anytime someone asks you about anything, you can always know that this is a debit, this is a credit, this is a debit, this is a credit. That way, you'll be able to tackle almost anything in financial accounting. So, moving on, we're looking at the bank reconciliation process. We're saying that the cash book and the bank statement will rarely agree at a given date. So if you're doing bank reconciliation, you have to take the following steps below. Step number 1, you have to post all the transactions that appear in the bank statement, but do not appear in the cash book. So what is going to happen is that you will get your cash book, okay? You'll get your cash book, and let's say you had payments of 10,000 and you had maybe receipts of 5,000. So that means, let me make it a normal example. You had receipts of 15,000 and you had maybe payments of 10,000. But you find out that when you pick your bank statement, they're actually payments of 11,000. There's an extra 1,000 that you didn't record. So you need to ask yourself, where has this 1,000 come from? So when you actually look at the bank statement, you may find that 1,000 was just maybe a bank charge. So what will you do? You go to the cash book and show that there was another payment that was made that I hadn't recorded. So you take note of any errors in posting transactions to the cash book and correct these immediately. Sometimes you might have miswritten a figure. To error is human, accountants are human. Must have miswritten a figure, and that is something you can adjust. And so you will adjust it, as we're going to see in the questions. So they were saying that the corrections and adjustments to the cash book will often involve the following: the payments made to the bank, so we're going to get the payments made to the bank or from the bank account by way of standing order, which have not yet been entered in the cash book. So one of the corrections that we are going to make will be the payments into the bank account. And usually those payments may be in a way of standing order. When you talk about standing order, we usually sometimes you may decide to tell the bank, you know what, I have these bills that I keep on paying every month and I'm tired of having to do it manually. Why don't you maybe every 27th deduct 10,000 from my account and send it maybe to National Water? Maybe you pay 10,000 for water every single month. Maybe you pay your landlord 1 million every single month. So you tell the bank You go and sign paperwork and you tell the bank every single month, I want you to deduct 10,000 from my account. Sorry, I want you to deduct 1 million from my account. So the bank does just that. So if you are the one, if you are the accountant of that particular person or that particular business, you will not know that the bank has taken the money. Yes, you may be aware of the standing order, but you may actually not remember. So when you look at the cash book and you look at the bank statement, you will find out that there was an extra 10 million that was as an extra 1 million that was deducted out. So that means that you have to manually now enter into the cash book and show that there was more money that was picked out, which was probably a standing order for maybe rent. We may have different dividends received on investments held by the business that may be paid direct into the bank but not yet entered in the cash book. So the business may have other investments. You may find this business is maybe it's a big business and it has other businesses where it has shares in. What will happen is that, or even you as a person, this could be you doing your own bank reconciliation, or even a small business, as long as you may have investments that you might have made. So you find that when they're paying you these dividends, just like how those of you who have shares in MTN, you find a mobile money message on your messages when it's time to receive your dividends. So even when you're receiving your 7 shillings, you will find an SMS. So let's say that you are recording a cash book of all your expenses, and you might not even know, you never know that SMS is going to be there that day. So let's say you've recorded your accounts as of 27th, you do not know what is going to happen. You've recorded your accounts and you've closed off the balances, and then only to go and see that you have more money on the account. When you check, you find out that you have dividends that were paid to you. So that could also be a reason why your balances may not agree. We have bank interest and bank charges that may not have been entered yet into the cash book. Usually also bank interest is a silent charge. You never know until you have actually seen the bank statement. That goes for bank charges as well. In as much as you know how much is going to be deducted every month, it's usually best you wait for the bank statement, look at it, and decide that, you know what, this has been deducted and let me enter it into the cash book. And then we also have errors that in the cash book that may need to be corrected. These errors could be errors of transposition, or maybe you debited what could have been credited. You put a payment on the wrong side. Maybe you put a discount where it wasn't supposed to be. Errors, anything could happen. And so you need to correct those errors in your adjusted cash book. So we're saying that take note that adjusted stroke correct cash book balance is the balance that is shown in the financial position. So eventually we'll look at financial reports, and part of our assets will be cash. So what this statement is basically saying is that you can only report full financial reporting. You can only report a corrected balance, or you can only report a balance that you're very, very sure of. So if you've been keeping a cash book and you know that you have 20,000, the bank statement needs to also have 20,000, because at the end of the day, the auditors will have to confirm what is on the bank statement against what is in the cash book. So don't just write the balance because you feel that is what should be there, or that is what should help you be, that's what should help you as a balancing figure. You need to be able to prove and defend your figures. So step 2, after we have identified the errors, we identify all the checks drawn, that is the checks paid by the business and credited in the cash book. So when we pay out a check, we are going to call it a check drawn. We draw that check. When we pay out a check, we have actually drawn it. So sometimes we may write these checks to people, tell them we have paid you, but these people may not have taken them to the bank yet. Maybe they have other things to do and they have not yet found time to go to the bank. So these checks, we are not going to just ignore them just because the bank hasn't recorded them. Like I told you, you record a transaction as and when it occurs, not as and when money is exchanged. So when you've written out a check and someone hasn't actually taken it to the bank, then we'll call that an unpresented check. Straightforward language, unpresented. You haven't presented it to the bank. Step 3, we identify all those checks received by the business that have been paid into the bank and debited in the cash book, but which have not yet been cleared and entered in the account by the bank. and do not yet appear on the bank statement. So sometimes we may receive checks. Unpresented checks, we are the ones who give them out. Uncredited checks, we have received them from our receivables, from our debtors. But we may receive that check, and clearly, like I've told you, accrual concept. You will receive a check of 10 million and immediately you write that you will debit your cash book. You debit your cash book in the bank column that you have received 10 million. But what is actually happening on ground is that 10 million is not there. It's not in the bank. The bank hasn't actually credited that money onto your account. So you find that there is a difference there. That is called uncredited check. It's very, very important. It's very, very key for us to understand the terminology of these checks, because this question will basically ask you about these terminologies. It's very important that we get them so that we also do not misplace them. So we write up the bank reconciliation statement as step 4, which will mainly include items identified in step 2 and 3, that is unpresented and uncredited checks. And this together will form what we know as items reconciling the corrected cash book balance and the bank statement. Basically, we call them the reconciling items. So these two unpresented checks and uncredited checks are in the adjusted bank statement. Every other thing up there will usually be in the adjusted cash book. So this is a format of our bank reconciliation statement. We have our shillings. Of course, always remember, you have your denominations. You have to make a report. The fact that we are dealing with money reports, we have to always show what denomination it is. We have to always show the level of precision. So the denomination is in shillings, and the level of precision is in thousands. In case we have decided to summarize to thousands, you may be making bank statements of $2. There is no need for you to put these thousands. That's misleading people. But of course, like with our economy, with our currency, we have so many zeros. You may find that it's okay for you to use the zeros also to be neat, because you don't want to now start making billions and writing all the zeros and finishing them. You may get confused since you're doing your papers manually. So we'll get the balance as per adjusted cash book. What does this tell you? This tells you that we will have to adjust our cash book first. Okay, we'll have to adjust our cash book first. So the balance that we get after we've adjusted our cash book, we're going to bring it to our bank reconciliation statement, and then we add unpresented checks. We add them back to the balance. Remember, we had removed them from the cash book. Why we are adding them back, I need you to see the logic here. Why we are adding back these unpresented checks is because, remember, we paid out money to people and we credited. Once we paid out that money, we credited our cash book. But because the bank hasn't actually recognized it, we need to add it back to the statement. Okay, and then we will less any uncredited checks. So the balance that we get is going to be the balance as per the bank statement. So let me just give you 2 minutes, internalize that, and then we can attempt the question. Okay, moving on. Activity 9.1 is telling us on June 30th, 2015, Mukasa's cash book showed that he had an overdraft of 300,000 on his current account at the bank. A bank statement as at the end of June showed that Mukasa was in credit with the bank by 65. What does that mean? Already you see that Mukasa had an overdraft of 300,000. That means that in the cash book he had a credit balance of 300,000. But at the end of end of June, the bank was actually showing that he had 65,000 on his debit side. So on checking the cash book with the bank statement, you find the following. Checks drawn amounting to 500,000 had been entered in the cash book but not been presented. So those will have to add back to our adjusted statement. Checks received amounting to 400,000 had been entered in the cash book but had not been credited by the bank. Those will have to remove. On instructions from Mukasa, the bank had transferred interest received on his deposit account amounting to 60 to his current account. So you see that the bank had also made an error. Recording the transfer on 5th July, this amount had however been credited in the cash book as on 30th June. So this, you see, this is a timing difference. Mukasa had instructed the bank, Mukasa, on instructions from the bank, on instructions from Mukasa, the bank had transferred interest received on his deposit account amounting to 600 to his current account, recording the transfer on 5th July. This amount had, however, been credited in the cash book on 30th June. So we need to see whether we're going to remove it from the cash book or whether we need to adjust the bank statement itself. Bank charges of 35,000 shown in the bank statement are not being entered in the cash book. This will have to show you also in the cash book on the respective side. The payment side of the cash book had been undercast. When you see the word undercast, I believe you had a lecture on errors. We know that that means that payments had been under recorded by 10,000, and so we'll have to increase the payments by that 10,000. Dividends received amounting to 200,000 had been paid direct to the bank and not entered in the cash book. We'll have to make that adjustment. A check of 50,000 drawn on deposit account had been shown in the cash book as drawn on the current account. So you see that there are two different accounts here. We have seen this problem with the current account and the deposit account. We're also seeing that same problem on instruction C or note C. So that means that we also need to be very vigilant and see which account we are dealing with and make the necessary adjustments. A check issued to Jones of 25,000 was replaced when out of date. It was entered again in the cash book, no other entry being made. So Jones got a check, so ideally we should have debited it. It was entered again in the cash book and no other entry was made. So we need to finish the other side of the entry. So both checks were included in a total unpresented checks shown above. So if Jones issued a check of 25,000, we issued him the first one and then eventually it was replaced and then it was entered again in the cash book. So if the check was replaced, what should have happened? Because that means that the first time that Jones made the transaction, he had credited it. And then the second time he went ahead and credited it. That means that Jones is showing that we are showing that we paid Jones 50,000, yet we actually only paid him 20,000. And both checks were included in total unpresented checks shown above. So we need to also make that adjustment. So let me copy this to the Excel sheet. Let me copy this to the Excel sheet. We're going to attempt that, and then we're also going to find an exam type question. We should probably do, you will pick whichever we can do, and then we will go forward. Let me copy this, and then we can get started. I'm sharing my Excel with you. Let me know once you can see it. Please let me know once you can see my Excel. Okay, so I've pasted the question here. I hope we are ready to go. Thank you for all of us who have given feedback. I also hope we are still together. We have not yet lost each other. So I have tried to zoom the question. I've pasted it in the Excel sheet. I'm hoping the working is going to be neat enough so that I can share this with you. But please, that doesn't mean that you shouldn't do your own notes. I'll just share this with you for the sake of your revision or future reference. Always working. One. Okay. So the question told us that on 30th June 2015, Mukasa's cash book showed that he had an overdraft of 300,000 in his current account at the bank. A bank statement as at the end of June 2014 showed that Mukasa was in credit with the bank by 65,000. On checking the cash book with the bank statement, you find the following. So you know immediately that there is a problem with with these statements. Why? We know that Mukasa's cash book showed that he had an overdraft of 300,000, but the bank is showing that he has a balance of 65,000. So ideally, what Mukasa's cash book is looking like, according to this question, we're going to go line by line. So ideally, what Mukasa's cash book is looking like, according to the question, let me show you how it's going to look like. Please let me know if the font is very small for you or not. Mukasa. Of course, we have to always make sure we put our titles as good accountants. Mukasa's cash book. As at 30th June 2020, was it 2015? 2015, yes. 2015. So which is that? So ideally, the question is telling us that the cash book for it believed, the cash believed that we had an overdraft of 300,000. That means that we won the credit in the cash book. So we're going to, of course, show we don't have the debt. So I'm going to start with details and my denomination, as well as my level of precision. Okay. Okay. So the balance brought forward, the balance that is supposed to be the balance that we are closing with. Okay. The balance that ideally Mukasa is closing with and ideally opening with is on the credit side. So usually, because a cash book is a cash book is an asset, it has a normal debit balance. So anything that is outside outside the normal debit balance means that there is a problem with that particular cash book. And so we are going to clearly indicate that problem. Excuse my debits and credits. It's just very disorganized. debits and credits. Okay. So the fact that Mukasa thought we have an overdraft, we're going to start working. We're going to adjust our cash book starting from there. From the fact that Mukasa's cash book was showing that he had an overdraft. So ideally in your cash book, you have a column for bank and cash. I'm not going to do that. I'm just going to show it the way it is, just like this, and that should be fine also, because we're basically aligning the bank column in the cash book as we're aligning it to the bank statement. So there is no need for me to start also now having cash, because there is no cash balance that we are aligning to, because if it's cash, the only balance we can align to is an actual cash count, and that is in a realistic point of view. So ideally, if you had your normal cash book, you would have another column here of you would have a column for bank, and then you also have a column for cash, and then you adjust cash and cash, then bank and bank. But because here we only want the column for bank to argue with the bank, it's the only column that we are going to have. So the balance was 300,000. If Mukasa had money on his account, or if Mukasa actually hadn't gotten an overdraft, he would have a normal debit balance. So I will be breaking it down for you as we go on, but also I will take you through how we look at the summary of basically double entry. So for today, you remember that when we have assets, okay, assets increase by debiting them. Assets increase by debiting. The assets increase on the debit side, okay? So every time you buy an asset, you will come and always debit it. Why? You will probably, let's say you're buying a car. When you're buying a car, you will debit your car and you always credit. Let's say you're buying a car is an asset. You always debit your car and you credit maybe the bank or whoever has given you the car. That was as per your double entry. Maybe you're buying stock. Stock is also an asset. You always debit your stock and you credit maybe cash or whatever you've used to pay. So you also see it as you keep on looking at these transactions. You'll see that every time you're buying an actual asset, you find that you're debiting that asset and you're crediting whatever means of payment you have used. Every time you're settling a liability, okay, you'll find that, let's say you have a payable to do. You find that when you're reducing that liability, you will debit. And whenever you're increasing that liability, you will credit. So let's say you have a supplier you need to pay. We know that whenever you're losing money, we know that whenever you're reducing your money, let's say you actually had a cash payment to make. Whenever you're reducing your cash, you will always credit. Whenever you're losing money, you always credit your cash, and maybe you're buying a car. Same thing, here an asset was increasing, but let's say you are buying that car on credit. Then what would happen is that instead of showing that you're using cash, you would show that you have a payable. And so your liability has increased. But I'll take you through the concept of double entry. In case you didn't get it, you would have to let me know earlier. In case, I'll just show you the summary of how these movements happen. So back to the question, because the cash, because money is an asset to the business, it naturally has to always have an opening balance that is on the debit side. So once that money is actually not there, but either way the account has to open. Once now, like for example, here we are being demanded money, then we have to show that we don't have that money, and that's why we are going to open on the credit side. So you will eventually see that this is already a liability. This is something, an obligation we need to tend to. And so you're seeing that we have credited it. Okay. So the question is telling us that for the bank statement, as at the end of June, showed that Mukasa was in credit of 65. So as you keep on practicing these answers, you usually know that we are going to calculate our statement moving towards this 65. Mukasa was in credit by the bank by 65. Mukasa had paid the bank, and at this point, he was the one demanding the bank 65,000. So he paid that 300, and then he even had extra money on the account. That's what this is saying. Mukasa was in credit by the bank by that money, 65,000. The checks drawn amounting to 500,000 had been entered in the cash book, but not been presented. What did we say we are going to? I need you to refer to your notes. We have the format. This check was drawn amounting to 500 but had been entered in the cash book but not been presented. This is an unpresented check. This will affect our adjusted bank statement. Right now, what we are trying to do, we are trying to adjust the cash book. Okay, so we have to show that we are working on Mukasa's adjusted cash book. Okay, so we'll leave that for now. We will come back to it when we are adjusting our bank statement. So we have checks received amounting to 400 had been entered in the cash book but had not been credited by the bank. This one, just by reading, you also know it's an uncredited check. That will not affect our cash book. We don't need to use these figures to adjust the cash book. So you move on. They're telling us that on instructions from Mukasa, the bank had transferred interest received on his deposit amount on his deposit account amounting to 60,000. So now we need to know, are we dealing with Mukasa's with Mukasa's deposit account or Mukasa's current account? This won't matter in other questions, but for the context of this question, it looks like Mukasa has two accounts and the bank is playing with them. Here, we go back to the question and she's showing us that Mukasa's cash book showed that he had overdraft of 300 on his current. It means that we are looking at his current account. So his current account had 300, but for us, we're expecting it to have 65,000. So that means that any adjustments that we are making should be towards adjusting the balance to match with his current account. Here, Mukasa has also a deposit account. The instructions are telling us that on instructions from Mukasa, the bank had transferred interest received on his deposit amounting to 60 to his current account. So this money shouldn't be in the current account. Okay, it should be in the deposit account, recording the transfer on 5th July. This amount had, however, been credited in the cash book as on 30th June 2014. So this money had been shown that it was removed from the cash book as on 30th June 2014. So what do we need to do with this kind of transaction? The money belonged to the deposit account, but however, it was put on his current account. The cash book itself had credited that in the cash book as on 30th June 2014. So that means that the cash book had already worked on it, but the bank hadn't. Okay, the bank is showing that this error was corrected in the next month, and yet for us we are looking at the bank statement as of 30th June. So we'll need to adjust that. We'll need to show that we'll need to adjust that error on the bank, because you see here, for example, they're telling us that Mukasa had even more money on the bank. The bank is showing that he has a balance of 65. It could probably be that this extra 60,000 was supposed to be belonging in the deposit account, and for the bank, it's showing that it's in the current account. So we'll have to adjust that when we're adjusting our bank statements. And then we're being told that bank charges of 35,000 shown in the bank statement had not been entered in the cash book. So clearly, these are credits. They're reducing our money. They ideally supposed to be reducing our cash. So they are payments. So we'll enter them. Because we said we are in shillings, our denomination is in thousands. So this is supposed to be 300, which is 35. Okay. The payment side of the cash book had been undercast by 10,000. So what that means is that we will come and add that undercast back to the correction of error, back to the, or I'll come and show that the payment side should be increased by that 10,000. So we'll come and write correction of error undercast, which will be the 10,000. And then they're telling us that dividends received amounting to 200 had been paid direct to the bank and not entered in the cash book. So we are seeing that we also received more money. We've received 200,000. 200,000 as dividends. We record 10. Yes, thank you. Yes, I've adjusted it to reflect. Maybe I could just do this. Okay. Moving on, they're telling us that a check of 50,000 drawn on the deposit account had been shown in the cash book as on the current account. So we had drawn money outside of the deposit account, but instead we showed that we had actually reduced it on the current account. And because we are reconciling the current account, we are going to have to add back. We're going to remove this 50,000. So ideally, it means that the error that the cashier had made, or whoever it was, ideally for them, they had gone ahead, and I'm going to show you the error, and then I'm going to show you how we're going to correct it. They had written a check. They had written a check of 50,000. But this check wasn't supposed to be written off the current account. It should have been written out of the deposit account. So how are we going to remove this 50,000? We're going to come and debit that check, so that they cancel themselves out, so that the 50,000 cancels itself out with the 50,000 that's already in the cash book balance. So this will not be part of our transactions because it is already there. It's already there in the original cash book. Okay, so moving on, they're telling us a check issued to Jones of 25,000 was replaced when out of date. It was entered again in the cash book, no other entry being made. Can you see my screen? Can you see my screen? Okay. So, like I was showing you, so when maybe let's give this check a code. Let's call it check A. So when check A expired, we wrote for John's check B. But we didn't show that check A had expired because everything that happened should be ideally recorded in account. So what are we going to do to correct this error? We wrote for John's two checks, one of which of course was expired, but we didn't show that it was expired in the cash book. So it shows that we gave John's 50,000. How are we going to correct this? I'm waiting for the answer in the chat. What do you think we shall do? What do you think we shall do? Yes, what do we do? Yes, thank you, Faith. We will debit check A. Why are we debiting check A? We need to get it out of our cash book because this check was actually expired. It's not going to go anywhere. The bank will not accept it, and it's now an invalid check. So what we are going to have to do is that we are going to come to our debit side because we need to cross out our check A. Our check A to Jones. And we're going to show that we have written it out of our cash book, which is that. So we'll then leave check B because check B is now the new check that we wrote. And the question why we are leaving check B, we would have also removed it. But the question is telling us that it was entered again in the cash book and no other entry was made. So we need to show that it was actually entered again. Sorry, the question is saying that it was entered again in the cash book, but no other entry being made. So ideally, this other entry also has already happened. It has already happened in the original cash book. So we only just need to remove the expired check, which is the original check A. Moving on, where I'm not seeing any other adjustments, so we are going to balance it off. So we are making, the question is asking us to get the appropriate adjustments in the cash book. This should be it. In case there is anything else, please feel free to let me know. And then in the meantime, I'll be balancing it off. This is 285. This is 335. So the bigger side is 335. 335. We are balancing both our accounts. 335 minus 285 should be 50. Let's see. Okay, let's see what is Pasty talking about. On instructions from Mukasa, the bank had transferred interest received on his deposit amount owing to 60,000 to his current account, recording the transfer on 5th July 2016. This amount okay. That. I hope that's okay for you. So yes, 50 will be the balance brought forward, but let's first explain the C. On instructions from Mukasa, the bank had transferred interest received on his deposit account amounting to 60 to his current account. So money that was supposed to be, let's say there is account A and account B. So A is going to be the current account, B is going to be, let me just indicate that so that we don't get confused. Deposit. This is a deposit account. So it's probably like a savings account. And then A is a current account. Current account. So on instructions from Mukasa, the bank had transferred. So Mukasa told the bank to transfer interest received on his deposit account amounting to 60 to his current account. So he told them to move money, to move 60,000 from there, okay, to here. So ideally, we should have debited, ideally the cash book should have debited that 60. recording the transfer on 5th July 2016. So it's outside our scope of reporting, because we are reporting as on 30th June. This amount, however, had been credited in the cash book as on 30th June. So the cash book recorded it as a credit from the current account to the if it recorded it as a credit, means that it moved it from the current account to ideally the deposit account, but that should have actually happened in July 2016. So what that means is that we're going to correct that error. They're telling us that the instructions from Mukasa had transferred the interest received on his deposit account amounting to 60 to his current account. He told the bank, move my 60 from my deposit to my current, and that was that the bank recorded the transfer on 5th July 2016. So ideally, either we'll have to we'll have to adjust the bank balance, or we'll have to adjust our cash book. So it can go either way. But we're saying that this amount had, however, been credited in the cash book as on 30th June 2014. So that means that instead what should have happened is that we should have ideally debited Mukasa told them to move to his current account. So we should have debited the current account with the 60. Okay. And we should have credited the deposit account with the 60. But instead, what did they do? They went and credited the current account instead with a 60. So how do we correct this error? So either way, if we record and show that we could correct this error one way, and we show that we are going to instead debit, we could remove it out of our current account and debit the current account with that 60. Okay, and that would write it out of the cash book. And when that is written out of the cash book, means that even in the bank statement it will not show, because the bank for it actually recorded this transaction on 5th July, so it would zero it out. Or alternatively, what we could do, we could in the adjusted bank statement, we could go ahead and show that there is a 60,000 that is supposed to be in the current account. So we could use either of the methods. So I'm going to take this. I'm going to come back to my workbook and adjust for that 60,000. I hope it makes sense. Sorry, I have explained it in bits. Mukasa told the bank to transfer his deposit, to transfer interest. So ideally the interest was on his deposit account. It was on another account. Okay. He told the bank to transfer 60,000 to his current account. Okay. But that money for it had already been written out, like it had already been written out in the current account. It had already been removed. Let me show you. So what had ideally happened, why don't we debit to correct the first error and make it the right entry? We need to know what exactly it's supposed to be, because at the end of the day, the bank also didn't record it in time. So we need to either see whether we're going to adjust it according to the bank, or we're also going to let the bank know. So let's see how the error is, and then we can correct it. Because instructions from the bank had, however, been credited in the cash book as on. So let's first credit it in the cash. Let's credit it in the cash book to be the 60,000. It's moving from the deposit account From deposit account, it is the 60,000. Then they're telling us that, so the original entry, this is what was done about it. So yes, you're right. We're going to have to debit with the 120 because ideally the money is supposed to be coming to the current account. The money is supposed to be coming to a current account, not getting it out. So there was an error that was made. Instead of debiting the current account, we actually credited the current account. So for us to correct that error, just like Faith has commented, ideally we will write it out. We'll first write out the 60 to remove this other money that was already to correct the error of the 60, and then actually now show the new deposit. So we could correct the error. Correction of error. It's just a transposition. We're going to correct the error. You can code it and say current to deposit account. And then it should be the same. Ideally, it should be the same statement. So for those of us who hadn't actually, Faith, thank you for noticing that in time. So for those of us who are still lost, Mukasa had told the bank to come and put some money in the current account, remove it from the deposit and put it in the current account. But instead, what the bank did, and when Mukasa recorded that, we went ahead and actually credited, went ahead and actually reduced our money in the cash book. So ideally, we made an error twice. We reduced money where we should have been adding it. So if we go on and add our 60 plus this other 60, we'll get 0. So for us to actually now make a new clean entry, we need to record another extra 60 for us to be able to clear that error. That way we'll have followed Mukasa's recording. And that means that also with the bank, we are going to have to make that adjustment because the bank balance as at 30th June doesn't include that 60. Doesn't include that 60. So moving on, this shouldn't be then our balancing figure. We're going to go on and add. I hope that makes sense, how we have corrected that error. I hope it makes sense. I'm going to go ahead and remove this 60 and then make it 120 so that we move on, because you don't record the correction of errors by showing the first error and then canceling it out and then showing the second error. You will just add up and the examiner will know what is going on. Okay. Please let me know if there is any other question before we can balance. Let me know if in case there is anything I've left out so that we can balance our cash book. We can adjust it very well. Like I said, I don't want to always just keep telling you and you watching the screen as if you're watching TV. Try to be as interactive as possible. In case there's anything I've missed out, let me know. This is it's supposed to be an interactive lecture so that we can all learn. Okay, so let's balance off our accounts. This should be the balancing side for 05. I know we all know how to balance by now, so I'm not going to start asking you to start balancing. So this is 395. When we balance that off, that's 405 minus 395. That is 10. Okay. Okay. So our balance carried forward, our actual balance carried forward. Our actual balance carried forward is supposed to be 10,000. So let's go on and look at our adjusted. Let's go on and look at, we have looked at, so this is how we're going to look at, this is how the adjusted cash book is going to look like. You're going to get the cash book, look for any errors that might have been made, and go on and adjust those errors accordingly like we have done. on this part A. And then going forward, they've told us to prepare a statement reconciling the corrected cash book balance with that shown in the bank statement. So for this second part, we already have a pro forma. You're just going to refer to your notes and you're going to tell me what we start with. As per the pro forma, it's basically you copying and filling in. What do we start with as per your notes? Please let me know. I'll be waiting for that part in the comments. What do we start with? We start with our balance as per adjusted cash book. There is a reason why I told us to have a short break for us to look at the pro forma so that we are able to internalize it. So that is what we're basically, there is no other way we are going to, we of course, there are other ways we can look at the adjusted bank statement or with the reconciling items, but for the sake of today, or for the sake of your class and this level, we are going to be using this particular format. Thank you. Well, we have said that we're going to start with balance as per adjusted cash book. Balance as per adjusted cash book, we have said it's 10. This is our balance as per adjusted cash book. That's the balance that we are putting there. And then we are going to go on and add, just like how the pro forma is telling us, we're going to add unpresented checks. Let's see. Does anyone else have 70? Did I miscalculate? This is 395. This is 395 minus 405. How do we have a 70? Please let's rebalance this and let me know what the closing balance is. Faith, how do you have your 70? We'll be waiting for the explanation of the 70. Please. Or no, we have to balance. We have to balance. We have to balance it off because we have our total debits being, sorry. We have our total debits being 10 plus 200 plus 50, that's 260 plus 25, that's 285 plus 120. That should be let's add that up. We have our 10 plus 200 plus the 200 plus the 50 plus our A, which is the 25, plus the 120, okay, which gives us 405. Of course, as per balancing, we have to get the side with a greater figure to be the one to be the total balance, and then we get the difference from the total figure against the lesser side to be the balancing figure. So we have to add the 60,000. We have to add the 60,000. Oh, yes, thank you. I'm so sorry about that. No, we have to write it out. We have to, sorry, yes, you're right. So I'm so sorry. Starting to get tired. Because it was already in the old cash book, so we can't include it here. We can't include it here. We can't include it in the credit. So sorry, apologies for that. That was an error. So when we recalculate, so this is minus 45. That will be 60. That should be our balance as per adjusted. Faith, thank you for that. I apologize, truly. I apologize for that. Okay, moving on, we're going to add our unpresented checks. We'll go back to our question. We can start with the down one, or we can start from up. Let's just go systematically. They told us that the checks drawn amounting to 500 had been entered in the cash book, but had been unpresented. That is very straightforward. That means we have an unpresented check of 500. We'll put it here. They go on to tell us, do we have any other unpresented check? Checks received amounting. So let me just, for the sake of time, let me also add what we need to remove. The format shows us that we also need to less uncredited checks. Uncredited checks. So let's do them. Let's do them together. So we have so far found our unpresented check, which is 500. We can call that check 1. Call that check 1. Going back to the question, the checks received amounting to 400 had been entered in the cash book, but had not been credited by the bank. Of course, also that is straightforward. We have an uncredited check of 400. So we'll come and show we have our uncredited check of 400. I'm going to call that check 2. Moving on instructions from Mukasa, the bank had transferred interest received on his deposits amounting to this, to 60,000, and recording the transfer on 5th July. So let's first put a pin in that for now. Let's look at this other note. Bank charges of 35 shown in the bank statement had not been entered in the cash book. This is a cash book entry. It affects the cash book. The payment side of the cash book had been undercast. This also affects the cash book. Dividends amounting to 200 had been paid direct to the bank and not entered in the cash book. That also affects the cash book. A check of 50,000 drawn on deposit account had been shown in the cash book as drawn in the current account. That also affects the cash book. A check issued to Jones of 25,000 was replaced when out of date. It was entered again in the cash book. No other entries being made. Both checks were included in the total unpresented checks shown above. So in the unpresented checks of 500,000, there was a 25,000 that had actually expired. So there was a 25,000 that was expired and an actual 25,000. So for us to get the actual, the net value of the unpresented checks, we're going to remove this expired 25,000. Okay, so we're going to come and adjust our unpresented check with the expired check of 25,000. Which is the expired check. So in as much as we wrote it out, it's expired, and so we have to make it obsolete. Okay, so when we add those up, when we get the net value, ideally, if there are very many unpresented checks, we just add them up, but I'm going to subtract because I need to get the net value of the unpresented checks, which is going to be less of the expired checks. And then we have the uncredited checks, which are only 400. So that should be 400. When I subtract, this is less, so I'm going to add my 60. plus the expired check, minus the 400. So my bank balance is showing, my balance as per bank statement is showing that I have as per bank statement showing that I have 1 as per bank statement showing, balance as per bank statement showing that I have 135. Now I want you to pay attention here. Okay, the question told us that the cash book showed that he had an overdraft of 300,000 account on the bank, and the bank statement as at the end of June 24 showed that Mukasa was in credit with the bank by 65,000. So ideally, the cash book was showing a balance brought forward of 300,000. Okay, and then the bank itself was showing that we have a balance of 65,000. So that means that the reconciling items here ideally should have been 235, and it should have been up to us to find where those 235 payments are. So what you're going to do to mark yourself, to check yourself and see if you're correct. The bank is showing that we have 65. So in all these adjustments that we have been making, we are supposed to adjust we're supposed to make our adjustments to ensure that we reach the 65,000. So what I'm going to do, I'm going to get my 65 and I'm going to put it here. This is just a side note, you're not going to do that. And then I'm going to ask myself why my answer is different. And my answer is different by a 70. So we're going to go back and ask ourselves, what did we miss, or what could we have misadjusted? They're telling us that the checks drawn amounting to 500 had been entered in the cash book and had not been presented. So we had our 500,000 that we had actually written out, and even in the cash book it was showing. So that was okay. We added our unpresented checks. We added our They're telling us that the checks received amounting to 400 had been entered in the cash book but had not been credited by the bank. We also have our uncredited checks of 400. Instructions. Okay. So let's come here. Let me show you what we are going to do. So on instructions from Mukasa, the bank had transferred interest received on its deposit account amounting to 60 to his current account. Okay, recording the transfer on 5th July. So the bank as at 31st June didn't actually have the 60,000. It actually so it means that when the bank was sending the statement as at end of June, it didn't record that 60,000. Okay, that 60,000 was not in the current account, but for us, we have now put it in the cash book. So we need to ask ourselves, do we need to put it in the cash book, or do we need to adjust the bank statement? So in as much as we had made the error and we're correcting it, that error is supposed to be corrected in the next period, because this transaction is actually going to, as per the records or as per our bank statement, is going to be adjusted on 5th July of the next month. So we could either go on and write it out of our cash book, because yes, ideally, just like Faith had told us, ideally, it's supposed to be an error that we are correcting, and we show that this is the right entry. But what is going to happen is that we have corrected it in a period that it's not supposed to be corrected in. Okay. Yes, the error has been identified. So back to, if I may just take you back a bit. we had our 60 here, and we had our other 60 here. So if it was a regular question, or if it was a normal correction of errors, we would have corrected them just like how we have been doing the 120. Okay, that is how it would have been, and it would have been okay. But now, this error, they're telling us that, I need you to be very careful about this. This error, they're telling us that Mukasa instructed the bank to transfer the interest on his deposit amounting to 60 to his current account, recording the transfer on July, okay, on July 5th. However, this amount had been recorded in the cash book as at 30th June. So this is a July transaction. So in as much as the transaction has happened in June, sorry, that is phrased the wrong way. It's a July transaction. Yes, a bit of it happened in June, but we finalized that transfer in July. So yes, we actually transferred to the wrong account, which is okay, and we're supposed to take it back, but we are supposed to show that it's in the right account in the next month. So it's in the month of July that we're going to show that we actually have a new 60,000 in our current account. So what does that mean? It means that for our old account, okay, for the month of June, we're only going to clean that error. And how are we going to? We're only going to write out the 60 so that we can show that it has been transferred in July. That's basically what I'm trying to say. So instead of writing the 120, we'll only have to write the 60 to cut out, to cross out the other 60 that was already on this side as per what the error had recorded, because the error, we know that it credited the other 60 on the current account. I hope that makes sense. Please ask me if it doesn't. Three, 9, 3, 4, 5. Okay, so let's which is 3, 3, 5, and that should be our 10. So we understand. So I'm going to go and now actually, yes, clearly show what it is, which is our 10, meaning that our balance is now 85. But, okay, our balance is now 85, but that still means that there is another adjustment that we still have to make. You always have to just cross-check the 65. You always have to cross-check the bank balance. The actual bank balance that is given in the question is what you're trying to adjust to. You're trying to adjust to. Unless they have explicitly told you that there is an error in the bank statement, we will work on the assumption that there is no error in the bank statement. So we go back to the question, look through it again. We have now clearly cleaned Mukasa's error. We have now clearly cleaned this transfer error. Bank charges of 35, that was done with, that was done for. The payment side of the cash book had been undercast by 10,000. We are going to have to find out if exactly we cleared the undercast the right way. Is there anything I could have missed out? Is there anything I could have missed out? Because if we're correcting an undercast, that means that, hold on. The payment side of the cash book had been undercast by 10,000. Every entry that we have made is okay. It's correct. So ideally, that should be our answer. But there is still a 20. There's still a 20 difference. There's still a difference of 20 from what we know to be the actual bank statement difference. So we need to either find it or we need to find out if the question has a problem. Let's go back. I'm just going to go back just to look through it again. was in credit, 35, 65. Checks drawn, amounting had been entered, received had been entered, but not been credited. Deposits. Okay, not to waste each other's time, I'm going to put a pin in this question. I'll check, I'll confirm with Innocent to make sure that every entry was given, every part of the question was given, and just to confirm where we could have missed or what could have gone wrong, and then I'll get back to you. So let me just, before we finalize, let me just go through another number. I'm going to share my notes. You let me know once you can see them, and then we can go on. I'll get back to you on this other question. I apologize for the mishap. I hope it will be better for the next class. Let me know if you can see my other notes. Please, can you see this other statement? Okay, prepare a bank statement. Sorry, the question is telling us, from the information given below relating to PW required to make additional entries in the cash at bank account, as you consider necessary to show the correct balance. They basically want you to adjust the cash book and then prepare the reconciling balance. Prepare a statement reconciling the correct balance in the cash at bank account as shown in above. So here we have not been given, now this is the balance at the bank, this is at the balance at what? No, we have just been given, we have been given our cash book, and we have been given a bank statement. You may find a question like this, or you may find one like we have been doing. So either could come, and it's all still the same concept. So this is our bank statement, okay? And they're telling us to find the correct bank balance and also find the correct cash book balance. So in such an occasion where you find that you are given raw information like this, raw data like this, they are not highlighting for you where the error is. The first step is for you to come and see what is the balance of the cash book. I'm seeing that the cash book has a balance carried forward of 14. That means that the cash book has a normal debit balance. That means that there's actual cash in the cash book. So ideally, this 14 should be the same. This 14 should be the same as the bank statement balance. From what I can see, the bank statement balance, if I may just confirm this column. Yes, the bank statement balance, as you see, this is the opening balance, this is 11135. And that means that the closing balance as at 31st is 3426. 3,426. And the other side, the cash is only 14. So that means that there is a difference of 13,400. Let me see, that is going to be 3,426 minus 14. There are reconciling items worth 3,412 that we need to do. So in the event of a question like this, what you will do is you will ideally every transaction that happens here in the cash book should be in the bank, and every transaction that happens in the bank should be in the cash book ideally, but that is not going to be the case. So what am I going to do? I'm going to come to manufacturing. I see I have on October 8th, we could start with our payments. Whichever is comfortable for you, you can start with that. On October 8th, I have manufacturing. Sorry. I have manufacturing on October 8th, which is 3,443. So I'm going to come and check my bank statement and see if it's there. October 8th, I'm not seeing that check. Is it the 3.8? This is the balance. So that check is not, that payment is not there. Could that be that we have an uncredited check? Someone paid us, but the money is actually not reflecting in the bank. So by virtue of you matching and knowing that you have not seen this particular transaction in one statement, it should be enough to show you that there is a problem. Let me just, I hope you're not tired, or if I hope it's okay, I could just attempt this question. Please let me know if we should attempt it or if we should just go through it just over the surface. It's up to you whether you're tired or not. I was a bit late, so I'm going to leave the honors to you to decide whether we should go through it or if I should just show you how to attempt it and then it can be your take home. Do you want it as a take home or do you still want to sit here? Okay, I'll take the silence that no one wants to tell me that they're tired. So let me just take you through it. So you're going to see, for example, Q manufacturing, we've seen that is 344. That means we received money we received money that is 344. So we're going to come, ideally when we receive money in the bank statement, it should show that it's on the credit side. Here, clearly they're even good enough, they've told us, they've shown us that we have receipts. So we're going to come and see on 8th, do we have any receipt of 3844? No, we do not. What does that mean? Is that we have an uncredited check. So we'll take the uncredited check where it's supposed to be. And then we'll come to payment. On 8th, we also had a payment of 1146. We're going to come to our receipts and check if we have 1146. Clearly, we also don't have it. So the money, it seems that all the money that was paid on 8th didn't reflect. We move on. We're checking the whole statement, it's not there. We move on. We have ESCO 638. We received the 638 from ESCO. We're going to come to receipts. 638 is also not there. It's okay, we move. All these are uncredited checks. So when you see that you've received a payment, but it's not in the bank statement, it means that you have actually received checks, but you have not yet taken them to the bank, or the bank hasn't actually put the money in your account. And so you will know that this is an uncredited check. We check Tea and Sons 512, received 512 from Tea and Sons. That was on 11th. We're going to come and see 11th. We also didn't receive that money. And so we'll also check U and SICO. We had 4174. That was on 11th as well, 4174. It's also not there. Okay. We'll check VICO. We have 1426. We'll come and check VICO and see if we have a 1426 that we received. Clearly, we didn't also receive it. So what is this telling you? We have so many payments that we received, okay, that we have so many checks that we received that the bank hasn't actually cashed out. So we go on and look at our payments in the cash book. We are seeing here that we paid wages of 3146. So ideally, this 3146 is supposed to be showing on the payments, and for it, good enough, it actually reflected that we paid 3146. It's reflecting in the bank statement. So this is just basically matching. And then we are seeing that we have petty cash that we also paid out from our bank. It should also come and show that we have petty cash, which is here, the 55 that we are seeing here. We have wages of 3106. These wages were paid on 8th. Be careful about the date. 8th, we are also seeing that we have our wages that actually reflecting. So from what I can see here is that most of the payments are reflecting, but it's the receipts that are not. So you will keep on checking when you find a payment that was not reflecting. You will know that was an unpresented check. So let me sample. This G Associates is 230, 28th and 22nd. You see, we paid G Associates. Okay, it's here, it's showing. It went and showed on 26th. I need to confirm that was the same person we are paying. Okay, so we have P and Sons. I'm sampling another person, P and Sons, 561 on 29th. P and Sons, 561. I'm not seeing that payment. So we wrote out a check, but this check hasn't actually shown that it has been deducted from our bank. So it's an unpresented check. These are uncredited payments that we have made, okay, payments that we have made to people, and they haven't yet taken to the bank, those will be our unpresented checks. And then payments that we have received that haven't yet that we haven't yet also taken to the bank will be our uncredited checks. So you will compare the cash book first, and then you go on and also look at the bank statement. So for example, we have our balance, which is 1135. That's okay. We have our check of 55. We are seeing that we paid out 55. We need to come and see on first. We actually have a payment of 55. It is there. It's there. It's here as cash. So that's okay. It's not a reconciling item. We don't put it anywhere. Once the things match, they're not. You don't put them anywhere because they're not reconciling items. They are not the causes of the difference. And then moving on, we already saw that this was there. This is our wages. Let's check let's check this check. It's 421. It's on 1st. October 1st, we had a payment of 421. So this could probably be a standing order. It's a direct debit. Okay. So this money was actually paid out, but it's only reflecting in the bank statement, but it's not reflecting in the payment. So this is something that will affect the adjusted cash book. So the missing transactions in the cash book will either be unpresented checks or uncredited checks. The transactions in the bank statement that do not match up will be the ones that are going to affect the cash book. That's the logic. Then we can check, we can sample. Here we are seeing, I know you've seen the word OD. That means that at some point we reached a credit balance. Our cash book was in the credit, was in the negative, which is okay. If the same word OD is on our closing balance, then there you would know that you have a problem. What that would mean is that you're going to close your account on the credit side. Instead of closing it ideally where you see that we've closed it here, the normal, this is a normal, even here actually showing that it's closed on the debit side, that means that it's going to open on the credit side. So it means that we actually also had an overdraft of 14, but that overdraft over time has increased. Over time it increased, but then we are also saying here, we are saying we opened with that 1135, and eventually we closed when we had already paid all the money, because if it was a negative, then it would also show that they would have shown in the question that it's an overdraft, but clearly we ended up on the debit side. So ideally, even our cash book should have closed on the debit side. So our balance brought forward should have been on this side, not on this side. Do we have any questions? Please, do we have any questions? I'll rectify the issue with the other question, and then we can start with that next on Wednesday. We can start with the rectified issue and then move on. Do we have any questions for now? All right, that's it from me for tonight. Have a good night. I'm so sorry once again for coming in late. Please, that doesn't mean that next class we should come in late. I will be early. I will be on time. I truly apologize for being late. Next time I'll be on time, so please don't come late just because I was late today. Thank you for being a good class. Have a good night.